Welcome to Markets Now. I'm Michelle Rook with Shawn Hackett of Hackett Financial Advisors. Friday's market closes pretty much higher in everything but part of the wheat complex. And Shawn, let's talk about corn and soybeans, a huge update in both because of the shock that we got out of the USDA reports. This was a game changer. Let's start off with corn. Yield down almost 4 bushels per acre, ending stocks down to 1.54 billion bushels. Did that surprise you with what we've been seeing with the spreads and what we heard from producers about harvest?
I don't think directionally it was too much of a surprise. We know there were a lot of problems in the growing season last year. We know the very hot, dry weather, record hot, dry weather during, the final phases of maturation definitely drew down the corn moisture and the soybean moisture to a very, very large degree, losing yield. And so it seemed to me like this was why the corn market had been rallying for weeks, surprising everybody. And this is sort of the culmination of where the market has been feeling we were going to go. And now we got this number, and this number is probably the final number we're going to get. I don't think there's going to get a lot of adjustment here going forward. From here on out with corn, it's second crop corn out of Brazil, and it's how many acres are we going to plant. That's going to be what's going to drive the market now that we are at this point in time.
But you did close the corn market above another area of chart resistance. So let's talk about whether $5 is in the cards. Do you think we can get to that level in the corn market?
Markets like those round numbers, Michelle, whether we like it or not. It just seems that once you start getting momentum, they like those round numbers at $5, at $4. And so it wouldn't surprise me if we get some momentum early next week with the funds trading momentum, moving the momentum, that we could get a push to $5. But it'd be hard pressed for me to think that we're going to be able to go much beyond that with as many acres as I think the estimates are going to be suggesting here in a little while that we're going to plant in the U.S. And assuming a normal crop, that would mean that this kind of minor supply tightness would be short-lived in the minds of the market.
And soybeans, we also got a cut there, a bushel per acre on yield and about 90 million bushels on ending stocks on soybeans, so down to 380 million bushels. How much higher do you think we can go there with that in mind?
We went from massive oversupply to well-supplied. So that's good. That's bullish. But, we're not the only game in town. In fact, Brazil is a much bigger game in town now. And so they're certainly going to be harvesting a large crop. Obviously, there's still debate how large. They're harvesting that crop starting right about now. And with the real as weak as it is, and its prices down there, as decent as they are, especially after this rally, they're going to be aggressive sellers into peak harvest here over the next 30 to 45 days. Very difficult to see July soybeans, for example, getting over $11 from closing, around 10.5. I just don't think there could be that much upside, despite today's report and despite the fact that we will likely plant less soybean acres in the U.S. That overhang's got to be eaten through before we can realize more than that.
And USDA did not change South American production numbers for either corn or soybeans in the report here today. Too early for them to do that?
It's too early for them to do that. I would say that, the next report, they're going to get some physical numbers coming out of Brazil to tell them if they're right or wrong about where they stand. That would be the first opportunity for them to shift gears up through the January report, unless there's been some crazy, wild weather situations. They tend to stick with statistics and they wait for the harvest to come in to make adjustments. The next report, maybe when they do that. I wasn't expecting that here.
And even with some of the problems we've heard about in Argentina, Brazil could likely make up for that, and we still would be at record levels. And if that confirms, how much pressure will that put on the soybean market? How low could we go?
Yeah, it's always a combined production, right? If Brazil's up and Argentina's down, but Brazil's up more, it's total production. But my feeling is, unless the Brazilian real were to rally like 10 or 15% from where we are at this price level, at the heart of harvest in Brazil, I would think that the July contract could revisit or visit the mid-9s again, a price level that prior front contracts, have liked to go to when they've been worried about oversupply. It wouldn't surprise me if we find that kind of a price level, assuming the crop doesn't get adjusted downward from here.
Right. And so we're going to trade that. Soybeans also are going to be maybe pricing in some tariff fears here when the new administration comes in as well, aren't they?
Yeah, in a very little bit, we're going to actually have President Trump getting in office. His cabinet will eventually get in, hopefully within a 30 to 60-day window. And then tweets are going to roll every day about who says what they're going to do, negotiations. We went through this before, Michelle, the first time he was president, and there's a lot of rope-a-doping that's going to go on where the tweet at 4 a.m. says this and somebody else says that, and the market's up and down. My view, when you have a rally and you have an opportunity to sell and you have a price level that's better than it was before, I just think you need to be opportunistic because we're going to have a lot of uncertainty, and uncertainty means selling rallies when you get them until you know more about exactly what's to take place.
And in the light of that discussion, let's talk about the fact that we had 45Z guidance that was announced today by the Biden administration on top of the big data dump that we already had. But the soybean oil market rallied 262 points because it looks initially like it's friendly. But are we getting the cart before the horse here? What will the Trump administration do with it?
Yeah, I mean, if this was the first year of Biden administration, it could mean a lot, right? Because it would stick. But the reality is nothing that Biden is doing here at the end is going to stick necessarily. It's up to what President Trump and his cabinet decide they want to do. So this is kind of like window dressing. How I view it is, they put it out there. It looks good. It gets a lot of press. But at the end of the day, it's about what is Trump actually going to do about 45Z and the general renewable diesel policy. What I think the market really needs to see and what I would want to see is clear evidence that they're going to limit imports of used vegetable oil from overseas. If we get that, that's when you could get more excited about the soybean complex and bean oil. Right now, I do think it's a little bit pushing the cart before the horse.
So we sound pretty bearish about beans and at the same time, maybe a little more bullish on corn. So you get a tug of war there. What wins out?
Well, I think ultimately the soybeans will win out. The reason I say that is because if we plant, let's say 95 million plus acres of corn, that's going to be a weight around the positive fundamentals that is driving the corn market right now. And to me, that's going to cap the ability for corn to go away to the upside until or unless we get sufficient weather worries during June, July to worry the market that reduced yields will overcome excessively high planted acres. So to me, the low soybean price relative to corn caps the corn price more than the corn price raises the bar on soybeans.
So right now, the funds are long in the corn market. They're still short in soybeans, maybe covering some of those. What do they do next?
My feeling is that, they're going to look at overhead resistance near $5 on the nearbys in corn. And I think they're going to view that as an opportunity to potentially take some chips off the table, especially if some of the stock market queasiness we've been seeing starts to gain traction as it may. Oftentimes a new president gets in, you get a lot of worry in the capital markets. It'll be a great time for those funds to lower their risk profile at a time of greater uncertainty.
You bet. Okay, so the wheat market, we didn't get a whole lot of fodder in the reports today, except maybe a little bit of an increase in acreage from what was expected on winter wheat. But overall, the wheat market, is it just going to lose out here to corn and soybeans or what?
Well, it has lost out. The report really didn't say much statistically, different than everybody sort of thought. There's just no catalyst for wheat. Yes, Russian exports are down a lot year over year. Yes, their ending stocks are down year over year, but the ruble has been crashing, keeping the Russian wheat price from going up. Unless that currency situation changes, your catalyst is post-dormancy weather in Russia, Ukraine, and in the United States. But that's 30 to 45 days away from here. And that's a lot of time for the market to absorb time before we get a true catalyst in the market. The only thing I could say is if the US dollar rolls over and if we get significant changes in the ruble, that would be your most near-term catalyst to maybe creating some short covering with a very, very heavily shorted speculative community in the wheat market right now.
Yeah, that dollar, though, you mentioned has been such a headwind for the wheat for sure. All right, we're going to end on a positive note. Sharply higher day in the cattle markets today. We've been making new highs for the move, even some contract highs with record cash trade. Everybody wants to know, how high does this thing project now?
When we look at the nearby, the spot price, the February contract, and you look at a continuation pattern, it's a wedge pattern that develops from a rising market. And this has been going on for over a year, Michelle. When you break out of that pattern, as we have, you measure the length of the move that went into the wedge, and then you project that move higher when you break out of the wedge. We broke out of the wedge on 190 spot, which would project about a 30 or 40 cent move higher if we mimic the move that went into the wedge. Nothing's perfect with technical analysis, Michelle. It could be a little different, but that's what technicals would say would be a measured move based on a very reliable bullish pattern when it breaks out like it appears it's doing right now. 220, 230, nearby cattle. That's what a technical picture would look like. Obviously, you have to watch price action. There can be black swans that can come along and change that. But for right now, that's the projection that you go with. The trend is your friend until it's not.
Yeah. Does it stop when the Mexican border opens to feeder cattle or not?
That certainly is a catalyst that could slow this down or could be a side swipe. I'm sure people are aware of it, but we need to be mindful for any major reversal on a weekly closing basis to change this breakout trend. But that could be one of the things to watch.
Fun to talk to you as always, Shawn Hackett with Hackett Financial Advisors. That is Markets Now.